Section 12, Defaults and Foreclosures. Unit 1, Defaults. Unit 2, Types of Foreclosure. Unit 3, Deficiency Judgments and Foreclosure Reduction. Unit 1, Defaults. Introduction and Objectives. Lesson 1, Forms of Default. Lesson 2, Non-Payment of Homeowners Insurance. Lesson 3, Poor Property Management. Lesson 4, Loan Adjustment, Modification. Lesson 5, Alternatives to Foreclosure. Lesson 6, CAR Short Sale Addendum. CAR Short Sale Addendum Breakdown. A. Short Sale Approval. The first section of the form identifies the deadline for lender approval of the short sale. The default is 45 days, but short sales can take considerable time to approve, sometimes several months. Sellers should verify with their lenders how long to expect before the lender will respond to the offer. B1. Time periods. This section covers inspections, contingencies, covenants, and other obligations, and when the deadlines for these begin. Buyers have two choices here: they can wait until lender approval is granted, or they can specify another date in the agreement. B2. Buyer's deposit check. There are also two choices in this section, and they pertain to the buyer's earnest money deposit. The buyer can choose to deposit the earnest money with escrow within 3 days of lender approval of the offer, or by another date specified in the agreement. C. No assurance of lender approval. This section notifies the parties of the lender's right to reject the offer. It states that the offer is not guaranteed to be accepted and, in fact, the lender may consider and accept another offer. The lender may also specify terms for approval, which the buyer and seller may accept or reject. D. Buyer and seller costs. This section puts the seller and buyer on notice that any expenses incurred prior to lender approval of the short sale, e.g., loan application fees, inspections, will not be reimbursed should the transaction fail to close. E. Other offers. Obviously, in a short sale situation, the seller is walking away with nothing, except, perhaps a bill by way of a deficiency judgment, and the lender is receiving less than the amount owed. Because of this, even after a buyer's offer has been accepted, the seller will continue to market the property to other buyers for backup offers, and the lender will review all such offers. This section of the short sale addendum discloses this to the buyer, and assures the buyer that the seller will notify the buyer in the event that competing offers are being considered. F. Credit, legal, and tax advice. This last section advises the seller to seek professional advice about a short sale and specifically the ramifications that a short sale may have on their credit and taxable liability. For example, if a lender approves a short sale and forgives the amount still owed, this amount may be added to the seller's taxable income. Considerations. Short sales can affect a seller's credit and may create additional tax liabilities. Sellers should always seek professional advice before agreeing to a short sale of their property. New versions of the short sale addendum and other real estate sales and purchase forms are released frequently. Make sure the information being used to assist clients is up to date. Alternatives to foreclosure. Available options will vary by lender. Bankruptcy. Sometimes a borrower in serious financial distress will opt for bankruptcy. With more than one form, there are specific nuances related to mortgage loans that should be understood before this step is taken. Bankruptcy is a legal action that eliminates or restructures debt, depending on which form or chapter is used. Bankruptcy can have long-lasting negative impact on the borrower's ability to secure loans. This option should not be taken lightly. Repayment plan. If a borrower is able to arrange a repayment plan with the lender, it may be possible to avoid foreclosure by catching up on delinquent payments. If available, repayment plans can vary significantly from lender to lender. Borrowers should investigate what options are offered by their specific lender. Short sale. A short sale is one that results in proceeds that aren't enough to cover both the amount the borrower owes to the lender and closing costs. Short sales require lender approval, and the lender may still seek a deficiency judgment against the borrower for the amount not repaid. Voluntary conveyance, deed in lieu of foreclosure. In lieu of foreclosure, some lenders will allow borrower to convey the property to the lender. This helps the borrower avoid the stigma of foreclosure, but it is still a significant credit hit. This option is usually initiated by the borrower, to protect the lender from accusations that it pressured the borrower into handing over the property. Loan adjustment, modification, moratorium, or forbearance. Forbearance is when the lender agrees to temporarily suspend payments in an effort to help the borrower avoid default and foreclosure. This is a suspension of payments, not a cancellation of payments. When the moratorium ends, the payments that were missed will be due in some form, and are often tacked on to the end of the loan. Recasting. A reconfiguring of the outstanding balance on the loan is called recasting. The lender can reconfigure the loan, including the term, to reduce the borrower's monthly payment. This is essentially a new loan, so the loan's amortization will be extended, e.g., the borrower may have been paying for 10 years, but will now face a new 30-year loan. For additional information about loan adjustment, modification, options, visit Fannie Mae's Know Your Options website. A quick note about FHA and VA involvement in foreclosures. FHA requires lenders to give borrowers options to avoid foreclosure, a recast or forbearance, for example. The VA also requires lenders to work with borrowers to avoid foreclosure. Poor property condition. The real estate loan agreement can sometimes include a formal provision requiring the borrower to keep the property in good enough condition that the value will not be diminished. Lenders do this to protect their position as the primary lien holder on the property. If the borrower were to default on the loan and the lender had to resell the property, they would want to get as much out of their investment as possible. Lenders aren't in the habit of policing borrowers to make sure properties are being well cared for, but if negligence to the property comes to their attention, the borrower may find themselves in technical default of the terms of the loan. It's important for the borrower to take care of repairs to the property as soon as possible. Homeowners insurance default. Lenders want investments to be protected, so in most cases, homeowners insurance is required. When homeowners insurance lapses and coverage is not re-established, this puts the lender at risk. The lender may place lender-required insurance on the property and invoice the borrower, or accelerate the loan. If not resolved, foreclosure activities may begin. You may know. Homeowners insurance can provide protection for the borrower in case of damage caused by things such as theft, vandalism, tornadoes, floods, fires, and earthquakes. That protection extends to the lender, as well, since it protects the lender's interest in the asset. Without homeowners insurance, the borrower is 100% liable for damages. Can you see why the lender wouldn't want this to happen? If the borrower can't afford to cover the repairs of any damage, then the property value is at risk. Did you know? Homeowners insurance can also provide liability protection for the borrower in case of accidents that occur on their property. As with damage to the property itself, this coverage protects the lender's interest should a claim be made against the property due to a judgment against the borrower. Borrowers can be held liable for accidents, so without the protection of homeowners insurance, they could quickly be in financial hot water. If the borrower can't afford to pay for the injuries and potentially other things, such as ambulance or hospital bills, then a claim may be made against the property. Types of default. A default may occur due to a borrower not making scheduled mortgage payments, not paying property taxes, or even poor property management. Here's an overview of how these types of default occur. Delinquencies. This is how most loan defaults happen. For one reason or another, the borrower falls behind on their payments and is unable to catch up. Most lenders allow a grace period, often up to 15 days after the payment is due, and if payment is received just after that grace period, the borrower may be faced with late fees, but no additional consequences. However, most lenders will take action against the borrower after 30 days of delinquency. This ordinarily comes in a notice of default. Lenders also don't like it when another lien threatens their position as primary lien holder of the collateral, the property, or their interest is otherwise put at risk. This is another form of buyer default, allowing a lien to be placed against the property. When this happens, a lender may call for acceleration of the loan. Property tax liens, other liens, and non-payment of homeowners insurance will trigger lender action against the borrower. Property taxes. When your property taxes are bundled in with your mortgage payment, it's difficult to become delinquent. But some residential property owners pay their property taxes separately, and most commercial loans don't include property taxes in the monthly loan payment. When property taxes go unpaid, the county notifies the lender, and the lender may decide to accelerate the loan. Liens. Additional liens such as those created by non-payment of federal, state, or local income taxes or home contractors can threaten the position of the lender as primary lien holder. When the lender finds out another lien is looming, the lender is likely to accelerate the loan. Homeowners insurance. As with property taxes, homeowners insurance is usually part of a borrower's regular monthly mortgage payment. Some loan programs allow borrowers to pay for homeowners insurance independently of their mortgage, but the borrower is required to keep their insurance current. A lapse in coverage means the lender's interest is at risk should something happen to the property, so lenders will require periodic proof of insurance coverage. Should coverage lapse, the borrower is in default. A lender may choose to put its own insurance policy in place, often at a higher cost, and pass the cost for this insurance on to the borrower. Poor property management. When a borrower allows a property to go into disrepair, it would be difficult for the lender to recoup its investment in the event of a foreclosure. To protect the lender's interests, the mortgage agreement will require the borrower to keep the property in a condition that will not diminish its value. Though rare, a lender could choose to accelerate a loan if a property inspection finds that the borrower is in default of the property condition requirement.